Welcome to our latest podcast. My name is Elizaveta Gridneva, and today I have my guest, Brendan Ahern, who is a CIO of KraneShares. Hi, Brendan.
Hello, Elizaveta. Thank you for the opportunity to connect.
Thank you for joining us. I know that you have been studying China on a daily basis for the last decade, if not more. And I also heard that you have that blog that called ChinaLastNight.com. Can you tell us more about it?
KraneShares, the roots of the firm are really focused on investing in the growth segments of China's economy and capital market. And that's evolved into seeing trends in China as well as Asia and packaging that as exchange traded funds. But our flagship ETF is the largest China ETF in the United States. And to some degree, that's really what we're known for. But I think the most important thing we do is providing a balanced, data-driven perspective on what's happening in China that I think sometimes the media can be overtly negative, that it's either China's about to collapse or it's about to take over the world. And so as professional investors, we want to look at China through a balanced, data-driven lens. And we deliver that on a daily basis, trying to highlight, if you're an investor in the space, what's really the most important thing that you should know about that maybe it's not covered in traditional media just because it's not apocalyptic or it's not one of the two extremes. So it's become quite popular, and I think it's really driven by the trust we try to build with investors on helping them navigate what's taking place in China's economy, capital markets, and the geopolitical situation.
That sounds great. And I will take chance of having you today, and let's dive right into it and discuss a little bit on China. So I think the first question is that we see that Chinese equities have rebounded since January 2024. However, in quarter four 2025, we already see it faded. So why do you think that's happening?
Yeah. I mean, just to your point, the Chinese market really bottomed in January of 2024, where we had this 3-year bear market. And we saw that basically derivative induced meltdown, the real bottom take place. And since then, the market has kind of grinded higher. It's been volatile. It's kind of 2 steps forward, 1 steps back. And what we've seen is, it's kind of interesting, is one, you have the market really faded after the third quarter of last year. And I think some of that is driven by, you had a lot of the investors coming back to China were very invested in growth stocks. At the same time, I think some of the economic data in China slowed a little bit. Some of the fundamentals, some of the quarterly results from the companies slowed a little bit. And at the same time, as you saw this pickup in AI and semiconductors, investors' preference shifted to the proverbial shovels of the AI trade. So companies like Samsung, SK Hynix in South Korea, TSMC in Taiwan, those 3 stocks really drove this incredible outperformance that since the end of September 2025, the KOSPI is up almost 64%. The Taiwan stock market's up 30%. And yet these growth stocks for China are down almost 20%. So one, I would just say you had a little bit of a rotation, and why we think it's important, why we think there can be a little bit of a rotation back is very simply that I don't think investors are giving a lot of these Chinese companies like the Alibabas and Tencents, the Badus. These companies have done a lot in AI with large language models, with cloud computing. And I think we'll see that very shortly, that these companies are going to be providing their Q4 financial results. So I think that's one factor. The other factor is a little more nuanced, which is one's definition of China is important, that there's really two distinct opportunity sets. You have the Shanghai and Shenzhen stock market, which is predominantly owned by investors in China. And then you have the Hong Kong market and US ADRs that's predominantly owned by investors outside of China. And professional investors, if I'm benchmarked to MSCI China, I basically only care about offshore China. It's about 86% of MSCI China is Hong Kong and the US ADRs. And I'm really not that focused on the Shanghai and Shenzhen, which again is mainly owned by investors in China. So you have these two Chinas, but because their investor bases are so different, they move differently. So even if we look at year-to-date performance, the Hang Seng is basically down a little bit. I mentioned these growth stocks for in Hong Kong and the US ADRs are down quite a bit more. But then if we look at the Shanghai and Shenzhen, they're actually up year to date. So I think it's just important for investors. These two distinct China opportunity sets move differently because the investor bases are so differently. And really this offshore China, the definition of China for professional investors, which is why I think you saw this migration take place. China came back with these growth stocks, and then that money came out and funded these proverbial AI picks and shovels, TSMC, SK Hynix, and Samsung. And now we think there's a little bit of a shift coming back.
That's great to know. Thank you for this information. I think it's really useful for our listeners to know about two Chinas and kind of follow that separately if they can. And another issue, sorry, yes, you would like to add something?
No, yeah. I mean, this is just it's such a big part of what we try to do at KraneShares is this education, because people will say like, oh, China's doing great or China's doing poorly. But it really depends on what your definition of China is, because they're so different. They act so different from one another.
Understood now. Yeah, that's quite an insight. Thank you for that. If we talk about housing in China, it looks like it still remains an issue. We've seen a lot of news on that, a lot of sensational news, like you say in the beginning. So what is happening now?
Yeah, we're seeing a significant correction in housing prices in China. Some of that was driven by the government's concern about over-levered property developers, and that's not turned into a financial crisis. At the same time, the fall in real estate prices has really weighed on households, because historically 2/3 of urban household wealth is invested in housing. That you've had this incredible urbanization take place in China over the last, call it 40 plus years. And so investing in real estate was a one-way trade. And that really stopped several years ago, really driven by a number of government policies that the government needs technology more than they need more apartment buildings. And so the government arguably created a little bit of this downdraft, but it's had an effect on consumer confidence. It's had an effect on domestic consumption. And so I think as much as China's economy, remember, the GDP is at an all-time high. The size of China's economy has never been larger, but it's been in tepid growth. It's been slow growth, healthier growth, arguably. And I think government policies are looking to stabilize these prices. And certainly we're finishing the big government policy meetings in China, the dual sessions. And I think, again, you're seeing more emphasis on really trying to raise the expertise of China's economy in terms of high-end manufacturing, technology, like artificial intelligence, semiconductors. That's really where there's a lot more emphasis going forward rather than infrastructure like we've seen historically. So as investors, knowing we've got this new 15th five-year plan, we want to focus where the government's focused. And that's clearly on technology, self-reliance, and looking to raise domestic consumption. So we think these are two very positive opportunities for investors in the year of the horse.
That's great. Yeah, and if you would say, what are the potential catalysts do you see for China market on its horizon? As you mentioned, technology, robotics, right? China is leading that sector. So all the automation technology, those are in the menu, right?
Yeah, 100%. Yeah, I think we see this implementation of the 15 5-year plan that none of the dual sessions has finished. It's now these government agencies will need to implement that plan. And so just to your point, it's about technology self-reliance. So that's semiconductors. A lot of those companies are listed on the Star Board, part of the Shanghai Stock Exchange, companies like Moore's Thread and Cambercon. So one, for us, we are investors in the Star Board. At the same time, the rise in domestic consumption as well as AI, we really think benefits the big technology players like Alibaba, Tencent, Baidu, JD. I think it benefits new players like Kuashu and Bilibili. Certainly, domestic consumption will benefit domestic tourism like Trip.com. So, really, as investors, we're quite constructive on the opportunity. I think we see positives, but I think the biggest thing investors should really be focused on is US China geopolitical relations. That we know that the US and China are having significant trade talks, and we have President Trump visiting China at the end of March. Then we know for President Trump and President Xi to meet, they're going to want to announce a lot of big deals. So I think what we see is an improving US China relations under President Trump with President Xi. Now, there's clearly a friendship, a mutual respect. Then we think a potential trade truce could evolve into a bigger trade deal.
Thank you, Brendan. That's great. And what other opportunities do you think investors should be on the lookout in China today?
Well, I think one of the real big opportunities is we know China's very good at high-end manufacturing. You see that with electric vehicles like BYD, battery companies like CATL. But certainly we think humanoid robotics is going to be a very big trend in the years to come. And we think this is part of an AI trade that humanoid robots are basically like remote control cars. They're like a toy. But when you embody them with artificial intelligence, this is where it becomes a very viable economic tool. And we think many Chinese companies are really at scale. Companies like Ubatech, it's already publicly traded, but really one of the key players, Unitree, is expected to go public this year. And I really think that like Alibaba really put China internet on the map. And I really think investors globally are going to be shocked that this isn't something where Tesla might be talking about humanoid robotics. Unitree's producing 300 humanoid robots on a daily basis. And again, I think the real key here is the artificial intelligence. And we're seeing other players in the space. There's a whole host of companies that we envision as potential beneficiaries. This will be a global trade, which is for us as investors, we're focused on the global humanoid embodied intelligence opportunity. And we really think this is a very exciting extension, the proverbial tip of the spear of AI, this embodiment of physical AI. And Huawei thinks that by 2035, 90% of Chinese households could own a humanoid robot. So this is something that's coming very quickly.
It's so exciting and interesting. Thank you for this insight. Thank you for joining us today, and subscribe everyone to our IBKR podcast. Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.